You've likely heard about the importance of diversification in your portfolio and when it comes to investing. And tell me if you can finish this sentence for me. Make sure not to put all your eggs in one basket. What if I told you that that's not really that good of advice? This episode is all about risk diversification. Welcome to the Gen Ed Show. This is the place where we teach you how to trust yourself and succeed in the modern age. My name is Eduardo de las Cuevas, your host, a college dropout turned serial entrepreneur running multiple 6- and 7-figure businesses. And so I hope in this show to teach you the things that you may not even know that you don't even know. So welcome and welcome back to the Gen Ed Show. This episode is going to be all about risk diversification. And we're going to be breaking this down over 4, or specifically 3, different points. The first one, obviously, going into the importance of diversification. The second thing we're going to talk about is how you should then diversify your risk and diversify your investments. And then lastly, what to diversify your risk and diversify your investments into. So the first one, talking about the importance of diversification. I know you've definitely been told, as I have growing up, that it's important that you don't put all your eggs into one basket, okay? Because in the same way, you don't want to have all of your, eggs in one basket where in case something goes wrong, that business goes out or something happens, with regulation or whatever the case. And so what if in the same way I might have encouraged you to start to challenge this question, okay? Because first thing is going to be, not so much in the challenging, but first thing being when it comes to the difference of rational investing and reasonable investing. So you can learn a lot more about this from The Psychology of Money. It's a book written by Morgan Housel, published in 2020 during the pandemic. Absolutely phenomenal book. And so with it, we talk about rational and reasonable investing. Rational is when you have your friend come up to you, or you have your financial advisor, or just from playing whatever numbers, you look at it and you go, I can see that these numbers logically make a lot of sense. You have your investing advisor come over and tell you, hey, mister, look at these numbers. This is a good move for you. And it can make a lot of sense, but that is what's going to make it rational investing versus reasonable investing being, it may not necessarily make a lot of sense on paper or seem all that rational, right? Because when we look at rational, this could be like your friend telling you, yo, or your investor telling you, yo, put as much as you can into this one. This is what's going to happen. But it just doesn't feel right. I've personally been in that type of position where, I was either encouraged or looking at whatever XYZ through marketing that really pushed me towards wanting to invest into this. And whether or not it was a good investment, it kept me up at night. That's why personally I lean towards reasonable investing, because it's centered around the idea of you being able to at least sleep at night. Okay? So when it comes to diversification of your portfolio, diversification of your risk, is that we want to be able to stick to things that, one, we can understand and have general knowledge within, right? So we're not just following someone else, but we can feel confident in this so that we can sleep well at night. And then 2, to make sure that you are hedging against truly that type of risk, because you never know what could happen to just one. There's a saying that to expect that the impossible won't happen or never will happen is completely improbable. Okay. It's just not a statistically possible thing. Something that we think is impossible is very probable because it's not actually impossible. That's just statistics. So then this brings us into the second point, which is how to invest and how to diversify your risk. This being, when we take that same quote, don't put all your eggs in one basket. I told you that this is bad advice. Put all your eggs in one basket and then watch the basket. All right, I'm going to say that one more time. Put all your eggs in one basket and then watch the basket. Because this is also the point of why it's called a basket and not a cup. Because if you just invested into one company, right, one stock, one coin, one business, whatever, then that's not really much of a diversification. And then perhaps this adage, or at least the challenge I'm making to you, to put all your eggs into one basket and then watch that basket is not necessarily going to sit, because you're not diversifying anything. Okay. And so this is why I said the second point to this is how to diversify your risk and how to diversify your investments. Put all your eggs in one basket, not a cup, and then watch the basket. So what are 2-3 industries that you feel very confident about, knowledgeable about, very in tune with, right? And then can we start getting into them? One that I always like to do is a good rule of thumb is if you are needing to buy something or consistently buying from this type of company or this type of product or this type of service, shows that there's clearly a demand if you feel the need to invest or purchase it on a day-to-day. That's probably a good business, or at least probably a good industry to keep tabs on. If you are in the film production or the video production side and you really like cameras, you're probably going to be paying attention to DJI, or you're going to be paying attention to some of these other types of companies, or if you're really, really, really into blockchain, really, really, really into, crypto, you might be a lot more in tune and feel a lot better about certain types of, coins like might be on an exchange. Like if you're getting Uniswap or your Uniswap, my bad, or Sushi Swap or Pancake Swap, or you get the idea. So pay attention to what you're knowledgeable in and then diversify specifically within that industry. Okay. You don't need to, and this is the biggest point here, you don't need to diversify into a bunch of random shit you don't even know about. Okay. That's not the point of diversification. Just because they say not to keep all your eggs in one basket doesn't mean to put your eggs into baskets you don't know shit about. Because then you're just definitely going to lose money. Then you definitely have a lot of risk, and that completely defeats the point of diversification. Okay? So put all your eggs in one basket and then watch the basket. Pay attention. All right? Be an investor. That's part of it. But look at where your money is. I check my money and my balance sheets dang near every single day. And I have automations for that too, because every morning, every evening, I have all my portfolios, all my accounts text me. And I get an email and text message every morning and every night, exactly where everything's going. So I don't even have to bother looking. It gets sent to me as if I had an assistant, but that's called technology. And this will bring us into the last 3, which is what to invest, what to diversify your investments in, what to diversify your risk into. And so there's only 3 things. If I can encourage you to put your money anywhere, it's going to be into these 3 things exclusively. Number 1 is going to be you. Always invest into yourself. Because what's for sure is that you can make a lot of money. Okay? You are always going to generate an income. For sure. Right? You're always going to generate some sort of income. You're always going to be able to solve some sort of problem. There is always inherently some tremendous amount of value in you. And the more money you put into yourself, well, what you appreciate appreciates. So if you appreciate yourself and you invest into yourself, watch what happens. Because then imagine if you can get yourself to go 1 year from earning 40,000 to the next year earning 80,000, that is 100% increase, 100% rate on investment, rate on return for all intents. And so then if you can continue to invest into yourself and that continues to go up, why would you not want to do that? I mean, heck, if I told you that you could invest into a stock right now and make 100%, double your money by the next year, do you want it? Probably, right? So that's always number 1, invest into yourself. Because then number 2 is invest into your business. Okay? Because you will definitely earn an income, and you can be for example, baller sales rep, someone that's earning 200, 300, $500,000 a year at the job that you currently hold with that sales position or as a sales leader. And you can still run another business, right? Because now you have this whatever capital from you, your primary investment, that you can then funnel into your business, hire some people, start running a little business on the side, right? And start earning an extra income. You know, if you can get that to 10 grand a month, boom. And you can have a 6-figure business on the side with another 200, 300 grand a year income actively you have with a job. And you can work things out. Now you have a lot of leverage too, because you keep investing into your business after you keep investing into yourself. And then lastly, after investing into your business, is investing into number 3, passive income investments. So what are passive income investments? They can be a lot of different things. For example, one of them can be like an ATM business. You know, you buy an ATM, scout a location, convince the store manager if they don't have an ATM there to let you put one there, put cash into the ATM and have it at the location and just continue to recycle it. Same thing with vending machines. You can do that. Same thing with any sort of e-commerce dropshipping. There's going to be expenses into this as well, though. Don't get me wrong. You can start a trucking company. You can start some sort of business. You can start a tutoring company, a tutoring business. You know, something that is able to be simple enough that you can pass it on to somebody else that can hopefully do it 80% as well as you, and obviously put some guardrails there, you know, kind of like bumper rails on bowling, so that this way they can execute their job effectively and you can put close to no time in it at all. This is if we want to create a hard asset, passive income investment that's a business. Aside from that, we can look at actual investment streams like buying property. I'd probably encourage you less of buying a normal family home, you know, single family home, but probably trying to buy a duplex, trying to buy something that is more like multifamily, something that can allow for more tenants specifically, something that can allow you to scale. And then from there, if it's not going to be that type of a property, creating an actual investment property, perhaps a commercial investment property, or with that, if you wanted to start buying a bunch of random cars and then putting it on Turo, because then you can lease out, you know, or rent out these cars on Turo. There's a lot of things that you can realistically be getting done and putting extra money into. And this, we haven't even talked about stocks and cryptos and different types of investments. If you wanted to invest into gold, if you wanted to invest into silver, if you wanted to invest into certain foods or food products, consumer staples, you know, things of that nature, things that won't generally be going away, right? So, but ultimately, the number one investment you need to be putting money into is always going to be you. You're always going to earn the most amount of money. And then so will your business, because you can influence that tremendously, because that number 3 is a passive income investment, because you can still influence that. You can still have some say in this, right? And of course, you can always move your money out. But before all of this, we have to make sure that income is taken care of. You need to earn a lot of income, because if you truly want to not have to worry about tremendous risk in the market or tremendous risk anywhere, and you truly want to be diversified, there's no better diversification tool than you. Just simply, there's no better diversification tool than you. You're really the best person out there, because you can infinitely learn. You can, for all intents, relatively infinitely grow. And so with that, you are capable of continuously increasing your income, because what's more important than money is income, because you can always be earning income, but you may or may not have money at varying stages in life. And that's a part of life. And especially if you're investing heavily, you may not have a lot of money, but thankfully you have a large income. So this episode is all about risk diversification, investment diversification, and we just walked through the importance of diversification and what to be diversifying into, and of course, how to be diversifying your money. And so with that, I want to leave you as I leave you always. Thank you so much again for tuning in. If you really enjoyed this show, this episode, go ahead and make sure you hit the like button. Make sure you hit that subscribe. Make sure to please, this is how we definitely grow. Largest is with your love, your help, your support, and sharing this show to all your friends and family, your Instagram, your TikTok, your social media platforms, so that everyone else can continue to learn and grow themselves too. And as I leave you always, make sure to be present, love deeply, and aim higher. Thank you so much.